6.49% mortgage pressure urges business leaders to improve financing strategy and build stronger housing plans. You need to face the reality that the average U.S. 30-year fixed mortgage rate has climbed to 6.49%, up from 6.43% just the previous week, forcing you to completely rethink your capital strategy. This shift is being driven directly by the 10-year Treasury yield, which has jumped significantly to 4.55% and is pushing up financing costs for millions of prospective homebuyers. At L-Impact Solutions, we see this development as a major structural alert that goes far beyond a routine weekly movement in interest rates. You are looking at a fundamental shift that alters how you allocate capital, shifts consumer confidence, and reshapes your residential investment strategies. High borrowing costs are rapidly stripping away your buyer's purchasing power, delaying first-time homeownership, and creating massive financial hurdles across the housing ecosystem. If you want to survive this shift, you must implement disciplined financial planning and structured acquisition strategies to protect your long-term investment outcomes. You are navigating a market where the median existing home price sits above $430,000, yet your buyers' incomes are failing to keep up with this pace. When you evaluate the numbers, you will find that a tiny mortgage rate difference of just 0.50 percentage points can add tens of thousands of dollars to your lifetime borrowing costs. You are dealing with an affordability index that has plummeted to near multi-decade lows, making your interest rate timing an incredibly critical business decision. While active housing inventory has gradually improved from the severe shortages you faced in 2023 and 2024, total supply remains well below historical averages in major metropolitan regions. You are hitting a wall because existing homeowners are holding onto legacy mortgages locked in between 2.5% and 4%, which keeps them from listing their properties. This powerful lock-in effect means you will continue to see restricted housing turnover, even though the underlying demand fundamentals from your buyers remain strong. You must recognize that financial markets are the core mechanism driving this trend, especially since the 10-year Treasury yield surged from 3.97% before the Middle East conflict up to its current 4.55% level. This rapid climb shows you exactly how geopolitical uncertainty, inflation expectations, commodity volatility, and government borrowing directly dictate your financing costs. Your mortgage lenders are pricing long-term loans directly off these Treasury yields as reference benchmarks, while adding credit risk premiums and secondary market spreads. Even though the Federal Reserve does not directly set your mortgage rates, its highly restrictive monetary policy continues to shape your daily financing conditions. Because persistent inflation remains stuck above the central bank's long-run target, bond investors keep demanding higher yields from you. This macro pressure is keeping your financing expensive, even though the current 6.49% rate is a slight improvement from last year's bruising average mortgage rate of 6.72%. At L-Impact Solutions, we advise institutional investors, developers, and lenders to shift their focus away from speculative appreciation and prioritize strict cash flow resilience. Your target housing demand has not vanished, but your financing efficiency is now a much bigger determinant of purchasing decisions than simple property availability. If you run a business in construction, real estate brokerage, mortgage lending, insurance, or building materials, you must immediately adjust your strategic planning to absorb higher capital costs. The biggest mistake you can make right now is assuming that your financing costs will magically drop back down to the 3% range seen during the 2020 to 2021 pandemic era. You have to realize that the Federal Reserve will maintain this restrictive stance as long as inflation threatens its long-term 2% stability target. If you build your corporate capital allocation around aggressive rate cut expectations, you risk making catastrophic decisions if rates remain stuck in the 6% to 7% range. You are operating in an economy where the national median existing home price is over $430,000, while the average median household income is stuck at approximately $82,000. On a $450,000 home with a traditional 20% down payment, choosing to finance at 6.49% instead of 3% hikes your monthly principal and interest payments by $770 to $820. This interest rate gap quietly adds more than $275,000 in raw interest expenses over a standard 30-year mortgage before you even calculate your taxes, insurance, and maintenance costs. You are battling a severe inventory imbalance because nearly 80% of all outstanding U.S. mortgages carry interest rates well below the 5% threshold. With a massive portion of those homeowners sitting comfortably below 4%, they simply refuse to sell and accept much higher financing costs from modern lenders. At L-Impact Solutions, we are tracking a dangerous disconnect between your buyer's stagnant wage growth and skyrocketing national housing costs. You are trying to sell into a market where home prices have surged by well over 45% since early 2020, while cumulative wage growth has lagged far behind. Even though average hourly earnings are growing at a steady 3.5% to 4.0% annually, this pace is completely insufficient to offset your elevated mortgage rates and construction inflation. You are seeing your first-time buyers get completely priced out of ownership, while financial institutions face a massive drop in mortgage origination volumes. Your mortgage banks and escrow firms are facing compressed gain-on-sale margins and lower transaction volumes because far fewer borrowers qualify for refinancing opportunities. You must manage massive execution risks as U.S. federal debt blasts past $37 trillion and annual fiscal deficits regularly exceed the $1 trillion mark. To protect your business from energy volatility and geopolitical risks, you must adopt scenario-based planning across multiple interest rate environments instead of relying on a single forecast. You need to start your acquisition process with disciplined affordability modeling rather than blindly borrowing the maximum amount your lender approves. Your total monthly housing expenses must remain within sustainable debt service limits, even if you stress test your numbers against an additional 0.50% to 1% rate hike before closing. You should run a comprehensive financing comparison and look closely at a 15-year mortgage, which is currently averaging approximately 5.82%. At L-Impact Solutions, we recommend exploring structured 2-to-1 buydowns, seller-funded interest rate reductions, or expanding your down payment to 20% or 30% to slash lifetime costs. On a standard $400,000 to $500,000 mortgage, securing a tiny 0.25% reduction in your interest rate generates lifetime savings exceeding $20,000 to $30,000. You will find that optimizing your structural financing creates far more wealth for you than negotiating a minor discount on the initial purchase price of the property. If you are a real estate investor, you must bake strict assumptions into your models, including a conservative 90% to 95% occupancy rate and a 1% to 2% annual maintenance reserve. You should pivot your capital toward multifamily housing, build-to-rent communities, and workforce housing, where demand remains hot because high rates delay homeownership. If you run a financial institution, you can cut loan processing times by 30% to 50% by integrating AI-driven credit assessments and automated income verification. You can use these advanced predictive models to optimize your capital allocation, improve portfolio quality, and maintain strict regulatory compliance as macro conditions shift. If you are a home builder, you must focus heavily on reducing your internal construction costs rather than relying on higher selling prices to protect your margins. You can slice your project timelines by 20% to 40% and cut construction waste by 15% to 30% by adopting modular construction and standardized designs. You will protect your profitability by increasing your production of entry-level housing, higher density communities, and transit-oriented neighborhoods. If you are a corporate employer, you should realize that offering down payment assistance and housing incentives directly protects your bottom line. You can eliminate massive talent turnover costs, which frequently average 50% to 200% of a skilled professional's annual salary, by actively supporting employee homeownership. If you are a public policymaker, you must accelerate zoning modernization and slash permitting timelines to fix the housing crisis instead of waiting for monetary easing. You will only achieve long-term economic stability by expanding infrastructure, building skilled labor pipelines, and driving sustainable inventory growth. To safeguard your household against future crises, you should build emergency reserves covering 6 to 12 months of total housing expenses and push your credit score above 740. At L-Impact Solutions, we advise lenders to stress test their active portfolios against mortgage rates scaling past 7% and property value corrections of 10% to 20%. If you are a developer, you should spread your risk across diverse asset segments, including senior housing, affordable housing, and mixed income projects. You must monitor macro indicators like crude oil prices, rental vacancy rates, and building permits to catch early signals before the mortgage market shifts. You cannot afford to sit on the sidelines waiting for ideal conditions while your competitors adapt to these evolving market fundamentals. You will preserve long-term value only by strengthening your internal affordability analysis, building capital resilience, and planning across multiple economic scenarios. Your ultimate success in this tough environment depends entirely on disciplined capital management, rigorous cash flow analysis, and strategic risk governance. Will 6.49% mortgage rates derail your housing strategy? Comment below. For more strategic analyses, visit our business consultancy website, link in the description below. Thank you.